Hi. After 20 years, actually over 21, probably 21, 22 years in the financial services space, I wanted to bring to you three signs that your bank is in trouble and also what is coming next. I want y'all to be prepared, okay? I don't want you to get slapped upside the face, okay? Let's talk about it. All right. I get excited to help people. I get excited to inform and so that you can do your own research. You can, check with your bank. All this information is public record. You should have access to their profit and loss statement or their balance sheet, so you can do your own research to find this out. So here's three signs your bank or a bank is over leveraged and what is going to come next. Okay, stay with me. Get a pen and paper if you want, or just replay this. All right. So, number one, too much debt compared to real assets. All right. When a bank's loan to deposit ratio climbs past 90%, that's a red flag. Look, I was with a financial institution and I remember I was the director of indirect lending, and I was told that we were 97% lent out, meaning banks or credit unions, we lend out money based on the deposits. Okay. So as people make the deposits, we get to lend it out. All right. So they're making money on deposits, you know, and they're maybe doing investments with your money. And then they lend it out too. Okay. And so they're making money on your interest and late charges and all that stuff. Okay. Some of them have origination fees. But basically, we were at 96 or 97% loan to value out. Okay. Well, I said, oh, well, I better stop doing loans because I had put like a lot on the books. All right. Not compared to what we did in commercial loans or construction loans, but not even close to compared. But I still put a lot of loans on the books, and I was worried that if we were almost 100% lent out, that was going to be a problem. And he said, no, don't worry, we'll just get a loan from the Federal Reserve, and like 2%, and then we can lend out money and lend out and make interest, more than the 2%, and then we make money on that spread. Hopefully that makes sense. So let's say we borrow from the Fed at 2%, and then we would lend it out at 4.5%. So we make money on that spread. All right. I wanted to make that simple for you to understand. So and we actually went under. Okay. When a bank's loan to deposit ratio climbs past 90%, that's a red flag. Okay. What it means is that they've lent out almost every dollar they hold. Okay. And if clients start withdrawing, they'll struggle to meet demand. So what if Fed is gone? We don't even have a Fed anymore. Okay. Where are they going to get their money? There's a lot of changes going on with money and with banking, and they're seeing a lot of charge-offs. So I'm just sharing what I've seen in the past and what I see is happening again. And I believe in the future we won't need all these banks, especially with all the changes in our money and how we spend money and all of these things. Okay. So number two, let's move along. Heavy exposure to high risk sectors. Okay. If a bank or credit union has a large percentage of loans tied to commercial real estate, auto lending, or startups, it's walking a fine line. We're seeing that with Tricolor, I think it is, something like that. They had 65 car dealerships close. And JP Morgan has taken a huge hit on that loss. Okay. And then there's many other institutions. I think it's Fifth and Third Bank and lawsuits and fraud. I mean, there's just a bunch of stuff. Okay. There's other cases with a parts store, massive, massive parts store called First Brand, I believe it is. Huge losses to some other banks. Y'all just keep your eyes peeled. I just want to bring awareness to what's going on. I think there's a lot of things that are being exposed right now. Okay. So high if a bank has a large percentage of loans tied to commercial real estate, auto lending, or startups, it's walking a fine line. When one of those industry drops, the bank's balance sheet can crumble overnight. Okay, if you have money in a bank and you're not covered, you have balances that exceed FDIC insurance or NCUA at the credit union, you want to pay attention to that. So, and we're seeing it right now. We have office spaces. Look around at commercial lending, commercial real estate. I mean, we have office spaces that are half empty. Dealerships are closing across the country like mad. And many of these loans were stacked on top of each other. All right. Here's number 3, low liquidity plus rising charge-offs. Okay, I just mentioned that. We're seeing a lot of charge-offs. Have you guys noticed that? Maybe if you're not seeing the news, Zions, they have banks branches in many states. It's a regional bank, so you may not have heard of them. But they're out of Utah, but they have a California location or maybe multiple locations in California, and that's one that's taken a huge hit. And those are the only ones they're actually sharing publicly. There's other, we just need to pay attention, okay? So when banks start reporting increased loan charge-offs, defaults, and simultaneously reduced liquid reserves, they're signaling internal stress. And a lot of times, I'll tell you, they will not, if you work at one of these organizations, these financial institutions, they'll say, oh, we're fine. I experienced that. I worked at Washington Mutual. We were told, we're fine. Go and talk to your business clients. Go bring in their deposits. Go see how you can serve them. And I felt uneasy about it because every day I was reading the news that we were in stress. We were experiencing stress. We were going to fail. And, then there was speculation that we were going to, be merged with JP Morgan Chase. I didn't feel comfortable based on who I am. Okay. I'm about truth. I'm about responsibility. I'm about, doing the right thing. I didn't feel confident in going out and asking for businesses deposits. I didn't feel confident based on what I heard online, and I thought, are they just not telling us the truth? What's going on here? It was very suspicious. And sure enough, we were merged with JP Morgan Chase. Our stock dropped massively overnight to a penny. And the next day, JP Morgan Chase was there, and a couple of people that I worked with lost their jobs like, boom, they weren't even there the next morning. So it can happen very fast. So when they start to do that, they move money around. Like it says, they might still look stable on paper, but behind the scenes, they're juggling cash flow to stay alive. You will not know about this because they want you to know that they're not going to announce there's a problem. We have to do our own due diligence, our own research. Look to see if you can see a balance sheet. Look to see how they're leveraged. Look to see what their charge-offs look like. Look to see what their delinquency looks like. And pay attention to, if they're over leveraged in certain markets. That's so important. Okay. They're moving your money around to survive. Okay, so here's the big picture. When banks become over leveraged, it's not just bad management. They don't do it intentionally. Like people think that I don't believe there's, like my situation, I had an incredible CEO and loved him. And I don't think that he was bad. I think he was a genius. I think he was great. I think he was open, he had vision. I think it was just the timing of the crisis, timing of, what we were going through. And I didn't see it coming. I was like, how could we fail? I've never been through an economic downfall before. It was my first time. And I didn't know what to expect. I was like, how could we be in trouble? Like, I never experienced it. Like we were rocking, we were rolling. I didn't watch the news. I wasn't ever one to watch the news because a lot of it's fake news and, later it was the Washington Mutual one, so I started paying more attention. But anyway, I don't think they're bad people. I don't think it's bad management. I think it's just sometimes things get exposed and media, it's just a lot of things. And when businesses go out of business, there's really nothing they can do. They just have to do their best to kind of keep everything afloat. I mean, if you've been in even your own home household, you could get in a situation where you have to file bankruptcy or something. You didn't intentionally have that happen. People don't intentionally want to see that happen, but sometimes it happens. Okay. I just want to make sure that if you have deposits there and all of that, that you're protected. Okay. So rising interest rates, bad loans, and economic slowdown expose who was swimming naked. So this is what you'll see. Okay, let's touch on that. That's when you'll see sudden mergers or acquisitions. We've already seen it with those California banks, that was in the valley of the tech, Silicon Valley. Okay, we've already seen it there. There's so many others that, aren't big headlines. Okay, the smaller ones you're not really going to hear about. So like Washington Mutual and Chase, I was there when that happened. Leadership retirements. Okay, when you hear that the leader, there's a CEO that just stepped down. Okay, a lot of times this is why things like this happen. And PR phrases like strategic restructuring. Okay, those aren't strategy moves, they're survival moves. Okay, they start letting go of people. I can speak from experience. All right, so if you're seeing banks merge, pull liquidity, or change their language, don't panic. Just know the corrections already started. Okay, you want to make sure you're covered. Make sure your money is structured properly so you're covered by these, FDIC or NCUA. If you guys have any questions, please drop them in the comments. I always respond. I'm here to help you in any way I can. I think that honestly, we're going to start to see, things changing. Banks, we're not going to need so many. Okay. If we're going to digital currency, think about it. Everything is so quick and so easy. Hey, look at it. It's 4:44. I got to screenshot it. It's a good sign. If we're, where was I going? Oh, we don't need so many banks. I don't know why we would need them all. Okay, AI is taking over a lot, a lot of jobs, even in the banking side. But we'll pivot. We'll do new things. There's other positions that you can use the skills. If you're in banking, you can use those skills other places. Okay. I believe it's going to turn more into what's called like a relationship bank. All right. It's not like a physical building, but it's someone that knows the banking industry in and out, and they have partners that they trust in all industries, and you can go to that person for any help that you need. But your money is in digital. It's not sitting in a bank. Okay. How simple is that? If you guys have any questions, if you haven't wrapped your head around the digital currency or you need any help with that, let me know. I can help answer any questions that you have. And if I don't have the answer, then I will find out the answer and get back to you. Okay. I love sharing however I can and helping people. Let me go on to this. What's coming next? Okay. Let's talk about this before we shut this down. So bank consolidation will accelerate. Okay. You'll see more mergers, acquisitions, rebranding in the next 12 to 24 months. This won't be random. Okay. It's how the system quietly absorbs losses. That's what happened in both situations, we were acquired by another credit union, we kind of merged with them. Us in executive management were let go. It was really unfortunate, and it really hurt me because it was my first time experiencing that. And I've always been such a good, loyal employee and worked very hard and really loved my clients. And I was devastated, to be honest with you. Maybe that's why I'm so passionate about this, because I just really care for people. Smaller regional or niche banks, especially in commercial lending or auto, will either be bought out or shut down. All right. Digital currency and smart contracts. Okay, this is what I want you to understand and why I think we're going to go more to a relationship bank. It's not a physical building. Okay, it's someone that you trust, you know, like, and trust. They have the resources to help you, the knowledge to help you in any need that you have. Okay, so we're shifting from asset-backed loans, your car, your home, your equipment, to blockchain-backed credit. Okay, where your crypto balance or verified on-chain history secures your borrowing. So what they'll do is, say you have your crypto, okay, in your wallet, and you can get a loan off of the money that you have there. Okay, that's your collateral. So say you have $30,000 in crypto. Okay, they will just secure that crypto. Maybe then they'll loan you out like 25,000, something like that. So and the loan process is so much easier. Like it's the way that they look at credit report, all that is going to be different. Some of it is based on um how you live your life. Are you serving? Are you, I mean, there's going to be like a social score, you know? It's very different. So this will reduce fraud because assets can't be double pledged. I talked about that the other day. So if you have a company that goes, and I saw it a lot of times when I was an underwriter, we had a dealership that actually took out loans on cars in multiple credit unions, financial institutions, on the same car. So then when they went under, and the way we found out is we couldn't get title. You know, we couldn't get the perfected title from the state. And they said it was because this other location, this other financial institution had a lien on it. And we're like, wait, we just did a loan on it. That's how that happens. Okay. Well, that's what they just saw with this Zions one. And, well, this other, what was it? The Cantor Group, V, they went and took they went and got 3 loans out on the same asset. Does that make sense? 3 loans out on the same asset, and the one that gets paid from that is the one that's in first position. So they'll take a loss. So that will reduce the fraud because you cannot, you know, there's all these, this is not an isolated situation. Like, this happens all the time. The blockchain will prevent that. Okay. But it will also increase surveillance. It protects from fraud, from individuals, from companies, from financial institutions, all of it. The collateral will no longer be your car. It will be your it'll be your, you know, your crypto. And right now, you guys, since it's just growing, it's in a new phase, like, to get involved and to get your crypto, it's going to blow up. Like, I would get in now, especially XRP. I don't know how I feel about the Bitcoin. I mean, it seems to be doing really well. And Ethereum is good, you know. As trust in big institutions fades, okay, this is where number 3, relationship-based finance will rise. Okay, as trust in big institution fades, people are losing trust in the financial institution. Okay, people will turn to relationship-driven advisors, trusted individuals who can help them navigate across banking, lending, real estate, car buying, wealth, all of the things. Okay, that's where I'm terming, I think I'm going to buy that domain. The relationship bank comes in, a decentralized network of financial professionals serving clients with integrity and collaboration. The future isn't about bigger banks, it's about better relationships. How do you feel about that? Tell me in the comments. Number 4, a shift from panic to partnership. For most people, this period will feel uncertain. But for those who understand the patterns, it's the biggest opportunity of our lifetime. So we need to look at this different. You know, some people are going to panic. Some people are going to go, I mean, I think everything that we experience in life, if it feels like challenging or whatever, it's an opportunity. If you can look at things as an opportunity and find the opportunity in it, you're winning. That's all I got to say. So when old world shakes, new builders will rise. All right. So what's coming next isn't the end of banking. Okay. It's the beginning of a new financial era, one that's built on transparency. I want transparency so bad. I do. Technology and trust. Okay. The question is, will you wait for permission or will you learn to be the bank? All right. To all of you financial advisors, bankers, business bankers, private bankers, commercial lenders, all of you guys, you have this is an opportunity for you. You could be the bank, okay? You could be the relationship and have, you know, all those relationships that you've built over the years to help and serve folks, okay? Um, anyway, if you guys have any questions, I'd love to hear from you. Let's connect, and I hope you have a great day. Bye.